Hi, my name is Jeremiah Lane, and I am a partner at KKR and portfolio manager on KKC, our listed investment trust in the Australian market. I'm here to provide an update on the credit markets, what we're seeing in the market, and an update on the KKC portfolio. I have three key messages. One, the market is disrupted. Two, this is familiar to us and we're well positioned to take advantage of the opportunities that this disrupted market presents us. And three, because of the performance of the portfolio, we are in a position to increase the distribution and commencing in the next fiscal year, starting July 1st, we will increase the distribution on the KKC units. The first is that the market is disrupted. And we see this in all of the markets that we're investing in: US bank loans, European bank loans, US high yield, European high yield, structured credit. All of these markets are experiencing a disruption fundamentally because of the change in the Fed policy. In the loan market, what we've seen is that the change in the Fed posture from quantitative easing to quantitative tightening has caused banks to look for more return in AAA assets that they invest in. And in turn, that's causing some decrease in demand for loans, and it's causing loans to trade to a wider spread. In the high yield market, the mechanism is a little bit different, but what I would say is simplistically, the 10-year government bonds started the year at 1.5%. It got as wide recently as 3.5% before retracing to around the 320 area. And that widening of 170 basis points, 200 basis points at the peak has meant that investors are demanding substantially higher yields on high yield bonds than they did at the beginning of the year. And as they demand a higher yield, price moves in the opposite direction of yield. So they require purchasing those high yield bonds at a lower dollar price. One of the things that we look at when we measure how disrupted the market is we compare the spread that we're able to get in these different asset classes today versus historical periods. And so on this slide, I'll speak to specifically the 7-year column. If you look at the 7-year column, the spreads that we're getting in the high yield bond market are about at the 40th percentile. 40% of the time over the last 7 years, you were able to get more spread than what you were able to get at May 31. Roll the clock forward just the 4 weeks that we've had of June, and that's all the way down to 23%. Only because of the widening that we've seen in June, at only 23% of the time are you able to get a wider spread. Similar stats in other markets. Today, as of the end of June, in the European high yield market, you're at the 4th percentile. In the European bank loan, you're at the 2nd percentile. These have gotten to the point where they're incredibly attractive levels to enter these asset classes based on how they've traded over the last 7 years. One of the reasons why we like looking specifically at the last 7 years is it captures several distinct periods of disruption. It captures the current period, it captures the pandemic, and in the US, it captures the entirety of the sell-off associated with energy that we saw at the end of 2015 and the end of 2016. So even looking at a period that has 3 distinct periods of disruption, this period stands out as offering particularly attractive spreads and yields. And so the market is disrupted, but we see it as attractive. Our performance has been in line with the market. Our assets do trade down when the market trades down more broadly. If you look at the 3-month period, our portfolio is down about 4.5%, approximately in line, a little bit worse than the high yield index. On a 6-month basis, our portfolio at down 4.1% is roughly in between the high yield index, which is down 6%, and the loan index, which is down 1.8%. The current yield on our portfolio, so just looking at the cash coupons that we're getting off the book today, stands at 7.6%. and on a yield to maturity, which also captures the accretion to par over time, given that the assets that we hold are trading below par, is all the way up to 10.5%. Critically, our duration is 1.5%. Duration is a measure of sensitivity to changes in government interest rates. And a low number means that we have low sensitivity. So you can see at 1.5, we're dramatically lower than the high yield index, which is at 4.2. And we're higher than the loan index because we don't have a portfolio composed purely of loans at 0.25. One of the key takeaways for all of our investors in KKC is that we do particularly well coming out of these moments of significant disruption. What this chart shows is in the gray is the spread on the high yield index. And so you can see three distinct peaks there: early 2012, end of 15, beginning of 16, and then of course the pandemic in March of 2020. The purple line shows our outperformance versus our index. And what you can see is that at each of those moments of a spike in yield, we were able to really outperform in the 12 to 18 months following that period. In some cases, 800 or 900 basis points of outperformance versus our benchmark. We have done exceptionally well coming out of these moments of disruption, and we believe that the period coming out of this disruption will be no different. So finally, key takeaways. The market is disrupted, but the portfolio is well positioned for the volatility that we're seeing. We haven't had defaults in the portfolio. We've been getting pay downs on some of our loans in the portfolio. That allows us to take advantage of the disruption that we're seeing. We are in an environment where our investment approach, a concentrated portfolio of our highest conviction ideas, has been particularly successful over a long period of time. And we believe that this period will be no different. And given those elements, as well as the increases in distribution that we're seeing from all of the floating rate assets that we own, we are in a position to increase the distribution to KKC unit holders, starting with the next fiscal year, which begins on July 1st. We'll be increasing the distribution target to 5.82% based on our current NTA of 2.2552. So with that, thank you for your interest in KKC. We'll continue to do these videos to update our unit holders with developments that we see both in our underlying portfolio as well as the market more broadly. Thank you.